What does trading psychology mean to you? Is it meditating in front of a screen, waiting for a great trade to arrive? Maybe you see yourself lying on a couch while a wise old investor quizzes you about your trading decisions. The reality is that trading psychology is not something you can see. It's about what happens in your head and understanding how to avoid any traps your brain is unconsciously setting. For example, many traders have a habit of moving their stop loss, hoping a trade will turn around. But most of the time, you'll just end up losing more than what you planned for. So trading psychology is really about learning how to counter bad habits. Another example is revenge trading. This happens when you've lost a trade and try to make back the original loss by entering into more new positions than you should. Again, the logic makes some sense, but the reality is that your decision to trade isn't based on what the market conditions dictate. It's about averaging your loss. This is dangerous, as you can easily lose more than you bargained for. Understanding your own trading psychology is about conquering bad influences and overcoming strong emotions that can cloud your judgment. Here are some quick tips to keep your trading psychology in check. 1. 3 strikes, get out. If you lose 3 consecutive trades, it's time to stop trading for the day. That's because a series of losses can push your brain into revenge trading mode, where you unconsciously raise your risk to try and win back your accumulated losses. Instead, just take a deep breath and trade again tomorrow. 2. Don't set a daily target. It's important to have targets, but don't let them dictate your trading. For example, if your goal is to make 100 pips a day and you've only reached 90 by the time the markets close, that's okay. It's better to stop trading than take risks trying to find opportunities that don't exist. After all, you've still made a profit. You've proved your strategy works, and the markets will still be there tomorrow. 3. Have a plan, trade the plan. Need help focusing on what's most important when you open a trade? Make a checklist. Setting a list of criteria a trade must meet will make it easier to know whether or not you should enter into it. If an opportunity meets your requirements, go for it. If not, just wait for the next one. Fundamental versus technical analysis. When it comes to trade analysis, there are 2 main types of traders. First are the fundamental analysts, who study economic data like inflation, GDP, and interest rates to try and forecast prices. Then there are technical analysts, who study charts and do their forecasting using drawings, indicators, and other tools. Traditionally, fundamental analysis is used for medium to long-term forecasting, whereas technical analysis can forecast everything from super short to long term. Even though these methods are different, they can work together. In fact, successful traders know how to take advantage of both. For example, to help predict which direction a currency is going to go, you might start by looking at the economic well-being of the relevant country. Then you might switch to a chart to confirm whether your original assessment is backed up by the data. If both camps of analysis agree, you can be more confident in your assessment and start plotting your entry and exit points. What is technical analysis? Technical analysis is essentially the use of charts to interpret where prices might be heading. To do this, most traders use popular indicators like the moving average, relative strength index, stochastic oscillator, Bollinger Bands, and more. If you're not into indicators, you can always do some drawing. Many traders add horizontal and diagonal lines, triangles, rectangles, channels, and even spirals directly onto price charts to help them interpret the trends. You might even want to follow a price action strategy and use candlesticks to light up your analysis. Or you could combine several forms of analysis to try and see the bigger picture. Whatever form of technical analysis you choose, the important thing is to pick the right tool for the right trade. And to do that, it's just a matter of practice. What is fundamental analysis? A fundamental analyst is like a doctor making a general health assessment. But where a doctor measures your blood pressure and cholesterol, a fundamental analyst monitors things like GDP, consumer price index, and interest rates for a country or economy. From there, they can assess whether it's in good health or not doing so well. Having this information can help dictate your trade decisions. If a country or economy looks like it's doing well, you would buy the relevant currency. If it was doing badly, you would sell. So, where do you get this information? Most of it is scheduled and easily seen using an economic calendar, showing all the important data releases, including GDP figures and interest rate decisions. Taken together, these economic events can be used to form an overall assessment and lay the foundation for your trade decisions.